With the development of generative artificial intelligence and the emergence of application tools, reports of AI-driven layoffs are occurring at an increasing rate. As the saying goes, there's always a trade-off. If workers' interests suffer, who benefits? The obvious answer is the companies using AI. To verify this, let's examine the second quarter earnings reports of some well-known companies that are replacing manual jobs with AI. For tech giants like Amazon and Microsoft, revenue growth is steady but not explosive. However, turning to the next page, the income statement tells a completely different story. Their profitability is soaring at an unprecedented rate. This isn't just a reflection of excellent management. It signals a profound structural shift. Years of massive investments in artificial intelligence, AI, are quietly transforming from a product into a utility, a core tool embedded within businesses that can significantly reduce costs and improve efficiency. The most important takeaway from the second quarter 2025 earnings season is that AI has evolved from a mere revenue driver to a cost reduction and efficiency enhancing engine for business operations. Companies that are the first to master and deeply apply AI to optimize their operations are building an insurmountable moat, and the capital market is only beginning to recognize the immense value of this. The most direct evidence of AI's ability to reduce costs and increase efficiency is to observe whether a company's operating profit growth rate exceeds its revenue growth rate. If so, it means that the company is spending less to generate each dollar of revenue, indicating a significant improvement in operational efficiency. Let's look at the latest data from tech giants. Amazon's revenue in the second quarter of 2025 increased by 13% year-on-year to $167.7 billion, a fairly healthy growth. But what is more remarkable is that its operating profit soared by 31% to $19.2 billion. Microsoft's second quarter of its fiscal year 2025, ending June 30, 2025, showed a similar trend. Revenue increased by 18% year-on-year to $76.4 billion, while operating profit grew even more rapidly, by 23%. To more clearly illustrate this AI dividend, the table below clearly illustrates the astonishing changes in the profit margins of these two companies. This table is the core evidence for my argument. It irrefutably demonstrates that these giants are not only expanding their businesses but also making money in a smarter and more efficient way. The profit generated per dollar of sales is increasing, and AI is the primary driver behind this. So how does AI reduce costs and increase efficiency for businesses? For a long time, investors' attention on Amazon has largely focused on its high-margin cloud services, AWS. However, the true power of the AI revolution lies in its penetration and transformation of Amazon's massive, but relatively low-margin core retail business. Amazon's first step in achieving this breakthrough was the restructuring of its vast logistics network. By dividing its domestic inbound warehousing network into multiple regions, Amazon can more intelligently place inventory closer to consumers. This move has directly led to significant efficiency gains. The average shipping distance for packages has been reduced by 12%, and the number of times each package is handled in the warehouse has been reduced by nearly 15%. But this is just the foundation. On top of this efficient physical network, Amazon has layered a powerful AI-powered decision-making system. A prime example is the AI-powered traffic management system called Deep Fleet. Think of it as a smart traffic cop tailored for warehouse robots. It coordinates the movement paths of thousands of robots in real time, finding the optimal solution and reducing congestion and bottlenecks. This technology alone has improved the efficiency of the robot fleet's journeys by 10%. At Amazon's massive scale, a 10% efficiency improvement translates into hundreds of millions of dollars in cost savings. These AI-driven efficiency gains have ultimately translated into tangible financial results. Operating profit for Amazon's North American business unit jumped from $5.1 billion in the same period last year to $7.5 billion. Largely due to margin expansion. At the same time, a stronger focus on cost control is also underway across the company. For example, its podcast division, Wondery, announced layoffs of over 100 employees in early August, a microcosm of the company's overall pursuit of operational efficiency. Ultimately, these efforts are reflected in productivity metrics. Amazon's revenue per employee continues to climb, demonstrating the effectiveness of its operating leverage. Microsoft's story illustrates the value of AI from another perspective. AI isn't just Microsoft's star product for external sales. It's also a powerful tool for empowering the company and improving its internal operational efficiency. The adoption of its AI assistant, Copilot, has been astonishing, with monthly active users exceeding 100 million, a penetration rate even faster than any previous generation of Microsoft 365 products. This not only represents a new revenue stream, but more importantly, it is reshaping the way knowledge workers work. This productivity boost can be clearly seen in Microsoft's financial statements. Let's analyze a key metric: selling, general, and administrative expenses as a percentage of total revenue. In fiscal year 2024, this ratio was 13.1%. By fiscal year 2025, when Microsoft had fully embraced AI, despite its larger scale, this ratio had fallen to 11.7%. This means that while Microsoft's business is expanding, its operating cost growth is slowing, and the company is becoming increasingly lighter. The most direct evidence comes from productivity per employee. In fiscal year 2025, Microsoft's revenue per employee soared 14.9% to a staggering $1.24 million. This eloquently demonstrates that AI tools are making every employee more powerful and efficient. By analyzing the cases of Amazon and Microsoft, we can identify three common characteristics of companies that successfully leverage AI to reduce costs and increase efficiency. 1. Possessing a proprietary data moat. AI models require data to feed. Having massive, unique, and inimitable data is a prerequisite for training effective AI models. Amazon possesses the world's largest collection of consumer purchasing behavior data, while Microsoft possesses Office documents and behavioral data from hundreds of millions of users. 2. Having a scalable cloud infrastructure. Processing and deploying large-scale AI models requires powerful computing power. AWS and Azure are not just products they sell externally. They are the cornerstones of their own AI strategies. 3. Company management should view AI as a core utility. Successful companies, starting from the top management level, view AI as a core productivity tool, similar to electricity, to transform every aspect of their operations, from logistics and sales to internal administration, rather than simply adding a new feature. For years, economists have debated the productivity paradox. Why have businesses invested trillions of dollars in IT technology over decades without seeing corresponding significant gains in macroeconomic data? Financial reports from the second quarter of 2025 may offer an answer. New technologies such as generative AI may be ending this paradox. They not only create new products but also radically reduce the operating costs of existing businesses. This shift has also triggered a massive migration in corporate spending. Companies are trading one-time, large capital expenditures such as purchasing AI servers and building data centers for long-term variable operating expenses, such as labor costs for certain positions. Amazon and Microsoft's rising operating profit margins are accompanied by a sharp increase in capital expenditures for AI data center construction. These capital expenditures ultimately flow to upstream AI companies, such as chip giant NVIDIA. NVIDIA's explosive growth in data center revenue is a direct reflection of the cost reductions and efficiency gains achieved by companies like Amazon and Microsoft through AI. This reveals a profound symbiotic relationship within the industry. The efficiency revolution at the downstream application layer is creating unprecedented, sustainable demand for the upstream infrastructure layer. In the next section, we will apply this blueprint to explore traditional industries poised for profound transformation by the AI wave and identify the rising stars most likely to achieve leapfrog development. Okay, that's all for now. We'll continue next time.